All right, before we jump in, just a quick but really important heads up. Everything we're about to cover is for educational purposes only. This is not financial advice. When it comes to your own investment decisions, please talk to a certified financial advisor. Okay, let's get into it.
Today, we are tackling a big one. We're doing a deep dive on the three heavyweights of the S&P 500 ETF world: VOO from Vanguard, SPY from State Street, and IVV from BlackRock. Now, get this. Together, these three funds manage over $2 trillion. They all seem basically the same on the surface, but the choice you make between them, it could have a massive impact on your financial future. Let's break down exactly why.
And right off the bat, we run into a real head-scratcher. You've got three different products tracking the exact same index and, as you're about to see, giving you pretty much identical returns. So the big question is, why should you even care which one you pick? Well, it turns out the choice matters a whole lot more than you think.
I mean, just look at this chart. Whether you look back 3 years, 5 years, or even 10 years, the performance is, well, it's basically a statistical tie. We're talking about differences of maybe 0.1%. This proves that it doesn't matter which one you owned, your bottom line returns would have been the same. This is true through bull markets, bear markets, you name it. So if it's not about performance, what is it all about?
The real difference isn't something you'll see on a performance chart. Nope. It's hidden away in the fine print. We're talking about the cost to own the fund and its fundamental legal structure. And this, right here, is where the story gets really interesting.
Let's kick things off with SPY. It's the original, the oldest, the most famous of the bunch. Its annual expense ratio is 0.0945%. Now, that sounds tiny, right? I mean, it's practically nothing. But just hold that thought for a second.
Because in a dramatic contrast, both VOO and IVV charge just 0.03%.
You did the math right. That makes SPY more than 3 times as expensive to own year in and year out. And while it feels like we're splitting hairs over tiny percentages, this cost difference compounds against you relentlessly over time.
And this slide right here perfectly illustrates the incredible impact. If you started with $1 million and just let it ride for 30 years, that tiny little fee difference could end up costing you over $218,000 in lost growth. That's the power of compounding working against you, and it is a huge deal.
So you're probably asking, why is SPY so much more expensive? Well, it all boils down to its blueprint. SPY is what's called a Unit Investment Trust, or a UIT. It's an older, more rigid structure that dates all the way back to 1993. You can think of it like a classic car. It's cool and it gets the job done, but it's just not as efficient as a modern vehicle. This old structure means it can't reinvest dividends right away, and it's not allowed to lend out its shares to make a little extra income on the side. VOO and IVV, on the other hand, are modern open-end ETFs. They're built for flexibility and efficiency, which makes them way better for most long-term investors.
Okay, so this brings us to a really crucial idea. These funds are competing in two totally different arenas. It's not about which one is better in general. It's about which one is built for a specific job. Think of it like a marathon runner versus a sprinter. They're both incredible athletes, but you would never use one for the other's race.
So, if long-term investing is the marathon, then short-term trading is the sprint. And in the world of sprinting, SPY isn't just in the race, it is the entire stadium. I mean, look at this chart. It's absolutely staggering. SPY makes up over 99% of all the options trading on S&P 500 ETFs. That's not just dominance, that's a total monopoly.
And the data just hammers this point home. SPY trades over $62 billion every single day. That's more than 10 times its closest competitors combined. This absolutely massive liquidity makes things possible that you just can't do with VOO or IVV. We're talking about access to options that expire on the same day, called 0DTE, and the absolute tightest trading spreads you can get. For an active trader, this is everything.
And hey, you don't have to take my word for it. This quote from an analyst sums it up perfectly. SPY's dominance creates this powerful feedback loop. Its huge volume attracts more traders, which creates even more volume. It's what they call a structural moat, and it's been getting deeper for 30 years. Bottom line, if you're doing anything with options or complex hedging, SPY is the only game in town, period.
Okay, so we get it. We've got our marathon runners and we've got our sprinter. Now it's time to figure out which race you're running. Let's break down the different kinds of investors to help you find your perfect match.
First up is the profile that probably fits most of us.
The long-term accumulator. This is someone investing for a big goal that's years or even decades down the road. Think retirement. This is our marathon runner.
So if this is you, what do you really care about? You want the absolute lowest cost possible, because every little bit you pay in fees is a drag on your long-term growth. You want it to be tax efficient, and you want it to be simple, something you can set, forget, and just let it compound away.
For this investor profile, the winner is crystal clear. It's VOO or IVV, hands down. Their super low 0.03% fee and their modern, efficient structure are purpose-built to maximize your wealth over the long haul. If you're a new investor just getting started, either of these is a fantastic choice.
Next up, let's look at the polar opposite, the active trader and options strategist. This is our sprinter, someone who's focused on short-term market moves and executing complex strategies. Their list of priorities looks totally different. They need incredible liquidity to move huge sums of money in and out of positions without moving the price. They need the tiniest possible gap between the buy and sell price to keep their transaction costs down. And they absolutely need a deep, liquid options market. For them, that annual fee we talked about is almost irrelevant.
And for this person, the champion is, without a shadow of a doubt, SPY. Its unbelievable liquidity and its complete stranglehold on the options market make it the only real tool for the job. You simply cannot do these kinds of trades with VOO or IVV. It's not even close.
But wait, there's a third, really important profile to consider, the big-time institutional manager. Think pension funds, massive advisory firms, that sort of thing.
Now, these folks have a whole different set of needs. They need daily transparency into the fund's holdings for compliance reasons. They need their funds to plug directly into incredibly complex portfolio management software, and they really value that extra income from securities lending, which can actually bring their effective costs down even lower. For this highly sophisticated user, IVV often emerges as the winner. See, its issuer, BlackRock, also provides the industry-standard management system called Aladdin. This creates a perfect, seamless ecosystem for big firms. You add in daily transparency and the biggest securities lending program on the planet, and IVV becomes the clear operational choice for many of the world's largest institutions.
All right, let's put this all together. Here is your final, simple framework to help you make a definitive choice that's right for you.
This last chart is really your key takeaway. Just find yourself on the left. If you're a long-term retail investor saving for something like retirement, VOO or IVV are your champions because of their low cost. If you're an active trader using options, it's got to be SPY. And if you're managing money professionally or investing in a regular taxable account where every bit of efficiency counts, VOO and IVV again have a clear edge. Oh, and one last super important point on taxes. If you're thinking about tax loss harvesting, do not sell one of these and immediately buy another. The IRS will see them as substantially identical, and it'll trigger a wash sale, wiping out your tax benefit. A better move is to swap into a fund that tracks a different but still similar index, like a total stock market fund.
So here's the bottom line, what looks like a simple rounding error. The tiny difference between 0.09% and 0.03% can compound into the price of a house over your investing lifetime. And that leaves us with a final, really important question. What other seemingly small details in your portfolio might be having a massive, outsized impact on your future wealth?
Thanks so much for joining us for this deep dive. And one last time, remember that this was all for educational purposes. Always, always talk to a qualified professional before making any financial decisions for yourself.